Good evening, everybody. My name is Sandeep Bhosle. I head the customer interaction team at Quantum Mutual Fund. Thank you for joining us on this Friday evening for Quantum Mutual Funds webinar. On 1st February, we had the Union Budget for 2022. A lot of investors may have questions around it, how it is going to affect their portfolio, what can be the next steps. So we have our speakers to answer all these questions for you. We have our guest speaker, Arvind Chari, who is the CIO for Quantum Advisors. We have Nilesh Shetty, the fund manager for equity, and Chirag Mehta, he's our senior fund manager for alternative investments. We will have a small presentation for around 20-25 minutes of time. You may post in all your questions in the chat window. Any questions regarding your portfolio, asset allocations, anything you want to ask regarding your budget, please be free to ask it and write in the chat room. Over to you, Arvind. Thanks.
Thank you, Sandeep. Welcome everyone to this discussion on budget. As Sandeep said, we will make a presentation which will cover what happened in the budget, what we liked, what we didn't like, what is the outlook, and then there'll be followed by asset class outlook by Nilesh and Chirag and myself on the debt side. So I'll take you through the presentation. So this is the Indian GDP growth, and this is pre-pandemic. Right? So this is the trend that has happened over the last 20 years. And specifically, if you see since 2011-12, the blue line, which is the real GDP, and the red line, which is the nominal GDP, which includes inflation. It's been on a downtrend. Multiple factors happened in 2011 to 2013. We had the issue of taper tantrum, where very high fiscal deficit, very high inflation, very high current account deficit made the RBI hike interest rates. The government had to cut its fiscal deficit, and that led to a slowdown. Just as we were recovering from that episode, there was multiple shocks that the economy faced, from demonetization, GST, and then the credit crisis. And then we had the pandemic. So India had already slowed down. The real GDP growth reported had gone down below 4%. And that is a scenario in which we entered pandemic. So prior to the pandemic itself, unemployment had gone up. Small businesses were getting impacted. The credit crisis had led to the fact that real estate companies which had a lot of debt, they were finding it difficult to raise money. NBFCs had problems. So that was the background. And then, as I said, the pandemic happened, and then it had a significant impact initially. But we are now seeing that the recovery, especially in the top part of the economy, the large companies, the salaried class, the top 10% of the individuals, there the recovery has been very, very good. And one reason that enabled that was the government shedding its what we call fiscal conservatism. If you look at FY14 to FY19, of course, these are reported numbers. There were a lot of off-balance sheet, but this is the fiscal deficit to GDP, which is the difference between the government's revenue and the government's expenditure fiscal deficit. And the Modi 1 or in 14 to 19, they were trying to keep the fiscal deficit low, which also reflected in the fact that the economy did not grow as much. Last year's budget, which was presented in Feb 2021, was the first effort by this government to say that, okay, we have to first prioritize growth, and then we can worry about other things. So they increased the fiscal deficit. It happened naturally because of the pandemic, because revenues went down and the government spent, but also they also committed that not only in FY21 and 22 and 23, till FY26, the fiscal deficit of the center and of the states will be higher than what's in historical. And this is important because at the end of it, India is a growth economy. Growth matters. When India grows, it solves a lot of our macro problems, like getting people out of poverty, getting the money to be able to spend on infrastructure, creating both hard and soft infrastructure, and most importantly, creating jobs for the young people that come out every year from our colleges. So growth is extremely important, and the government rightly focused on trying to get growth and then worry about, whether debt levels are high and interest rates are going to be higher. And this budget, what they announced 3 days back, continues that thing. So there was a very clear priority given to growth over controlling the fiscal deficit or controlling the interest rates. And within that, there was a significant increase in the what we call as capital expenditure on roads and on ports and assets which gets created in over a 2-3 year period and then has a very long period. And that is very important, right? We know that investments are what drives potential GDP over a long period of time. And when the government invests, it invests in a very broad range of sectors, right? As I said, roads, they will do spending on telecom by laying the optic fiber. They will spend on research and development. They will spend on, some kind of engineering. There's a very broad aspects of infrastructure, both hard and soft, that the government spends. And when they do capital expenditure while creating long gestating assets, it has an impact on growth. And as this chart shows, over the last 4-5 years, there's been a effort to increase capital expenditure, which will drive growth over a period of time. And then this budget especially had a fairly large allocation, as those bar charts show, both government and then the whatever capital expenditure the PSUs do. And if you add state government capex, that tends to be even higher. So there is a thrust to what we call supply side reform, in the sense that get the investments out, spend on investments, create the infrastructure, and that will drive demand and that will drive growth over a period of time. So that was very good to see, because if some of you who attended our previous webinar in December, we spoke about why we believe that India is on a cusp of a sustained economic recovery. And I'll summarize that. We said that corporate balance sheets are at in a much better situation than what they were in the last 4-5 years. Debt levels are very low, profitability is high. Bank balance sheets are improving. Every bank has raised capital. They are very well capitalized, and NPA levels have gone down. Exports have picked up. Global, all governments globally have expanded the fiscal. So there has been a global increase in global growth, which is helping Indian exports. There's been some revival that we see in residential real estate, and that's very, very crucial. It has a huge multiplier in the economy when real estate, when people buy homes. And finally, capital, the availability of capital across, whether you've seen equity markets or you've seen FDI, you've seen private equity, you saw money coming in the venture capital, funding startups, and they become unicorns. Availability of capital, especially as China, people want to reallocate from China. India is the large market to access that. And so those were the tailwinds, and plus this government expenditure. So all this put together makes us very optimistic about the fact that if the government is actually able to spend this capital expenditure in the right time, efficiently over a period of time, then this growth momentum that we are seeing should be able to sustain. If I see in terms of where they have spent, there has been a reduction in food subsidy, which is understandable in the sense that this is government telling you that now that we are out of the pandemic in most respects, the free food program that the government was running is not required. Similarly with Manrega, they are expecting that the migration which happened, which people went from cities to rural areas, as the economy recovers and most of the economy changes and opens up, the labor will come back. So the demand for Manrega will be lower. But they also are spending more towards roads. There is a continued spending in building houses. So there is a broad-based level of spending that is happening in the economy. This is one from the disappointments that we had from the budget from a macro growth perspective. One is this disillusion. Every year you have a high target, and we are seeing that the government is kind of failing to meet that target. Be it with disinvestment, be it with privatization of, we've just got Air India and we got the other NINL, but there are a lot of other companies which have been there for divestment, but the government has not been turned on. And this is an indication by the government by reducing the estimate itself for this year and next year. It is telling you that maybe they are not as confident of privatizing, and so keeping the expectations low. If LIC happens this year and if BPCL happens next year, then then there's success and there is upside. But otherwise, this is one level of disappointment where, because the government was spending so much, more divestment, more monetization would have helped the government fiscal deficit. The other, which is a larger area of disappointment, which we've been writing and talking about for a long time, especially before and after the pandemic, is India, the government is focusing rightly on creating supply side, which is spending on capital so that the potential growth will be higher. But there is an immediate problem today. Look, think about the issues that people have faced over the last 2-3 years, right? Especially during the pandemic. People have lost livelihoods. Quite a few people have lost their incomes, or even if they've got back their incomes, it is a much lower level. People have had health costs and they've spent on health. The taxes, like, people are paying higher price on petrol and diesel. There's an increase in inflation. There's an increase in commodity across the board. If you put all that together, we still believe that the government should have continued to support either a income support or by reducing taxes, by reducing, say, fuel prices, by cutting import duties on certain key products, by which way you'll get some relief, or take some MSMEs and give them a 1 or 2 year tax holiday on their corporate tax, something of that sort. It need not be only income support, but it could be a combination of that. The government's total expenditure is 40 lakh crore. Out of that, even if they would have allocated 2-3 lakh crores to do this, support income, boost some demand, and improve sentiment. Because if you look at this chart on the right, the consumer sentiments have increased, they're getting better, but they're still way below what it was before the pandemic. And even if you look at the left chart, which is the employment levels, people who are tagging themselves as self-employed are also people who have gone out of the job and are doing something on their own at a much lower income, much lower level. So that self-employed line looks above, but it is not reflective of the fact that they're earning much more. Their incomes are actually lower than what it is. So if given this, this is the disappointment that we had, that the government could have struck a balance between spending on capex and providing some demand, some consumption support. Because as we see on the left chart, investments are required, and over the last 10 years, same that we saw in GDP chart, the capital expenditure by the private sector companies or by households, mostly real estate, has gone down as a percent of GDP, which is why the government is now stepping and saying, if you are not investing, then I will use my resources and I'll invest and I'll create infrastructure which will drive demand. But that driving demand has a lag. Right? It takes time for the government to get approvals, acquire land, create a road, and the benefit of that flows over some period. Which is why on the right hand side, if you look at many other aspects of economy are now above the pandemic levels. But if you look at consumption expenditure, this shows that people's incomes are still lower, sentiment is still weaker, and it requires support, especially in services sector, which is a large employer, which has been the most impacted. So some amount of balance between capital spending and supporting income, I think that was lacking, and we should worry about that. Whether this budget makes us increase our GDP estimates, for now it doesn't. We like the budget in terms of the spending and capex, but we will still wait for this, whether the demand and the sentiment and the consumption improves on its own, and or whether it takes time. The second problem that India faces right now is inflation, both global inflation, oil prices, and the fact that import duties on so many products have gone up. There we are seeing price pressures, and whether that gets bad, like if oil prices go to $110, $120, which a lot of economists are predicting, that will be a scenario where in the short term, India will have a macro issue, and it will impact both equities, bonds, and the currency. So we are waiting. We like the budget. We think the economy will sustain the momentum, but we'll have to wait and see whether the capex spending actually happens and what kind of momentum it creates in the economy. So this is our people who have been regular listeners of Quantum would have seen this chart many times. This is a very simple assessment of seeing where do you get the returns and what kind of return potential can people think when they invest in equities with real GDP that we assume at 6.5%, inflation at 5%. And when nominal revenues, which is at nominal GDP, if I corroborate that to nominal revenues and that revenues become profit, and companies which are better, more efficient, the typical companies that are listed or which are in the index are much better efficient. They have better products, they have better teams, and they should be able to grow at a higher pace. And that's the way to think about equity returns. You can think of the same in the bond return. If instead of the 5% inflation, the inflation is 7%, then you would assume that interest rates would be higher, your fixed deposit returns will be higher. Whereas if there is a slowdown and inflation is at 3%, your returns from your short-term fixed deposits or short-term liquid funds will be lower as it is currently. But you will make money on your long-term bonds. That's the way to think about generally. And if I take a 20-year history of Indian interest rates and Indian GDP, so the repo rate has been between 6 and 6.5%. The 10-year bond yield has been between 7 and 7.5%. Inflation has been between 5.5 to 5 to 6%. And the real GDP growth, if I take a 20-year period, it's been between 6.5, 7%. So India can manage a slightly higher interest rate and still grow, which is what the historical average has been. In terms of how you should think about investments, what does this budget mean for you? Now we can give you all these analysis and we can talk about the impact. But as an investor, you should still keep your framework very simple. And this is a very generalized, simple way in way we talk about how investors should look at their asset allocation. And so this is the 12, 20, 80, the approach that Quantum uses, is that the 12 is the 12 months of emergency corpus. So whatever is your expense multiplied by 12, and that's your emergency corpus, right? If you lose your job, as many would have done during the pandemic, or if your business suffers an issue, you still have a corpus which you can use and tide your family over a, say, 12-month period. That money is sacred money. It has to be kept in the most safest asset class. It could be money in your mattress in cash. It could be in a savings account. It could be in a liquid fund, or it could be in a fixed deposit. It should be in a place where it is easily available. So it's liquid and there's no risk on it. So the objective of that emergency corpus is not to try and earn any returns. Keep it as safe as possible. Once you do that, then you can allocate 20% to gold and 80% to equity. So people who do not want to complicate, and you can just follow this 12, 20, 80. 12 months of emergency corpus, very safe, no returns, just safety. 20% of your money in gold, in any gold instrument. We typically recommend the ETF and the savings fund, and 80% in equity. And Chirag will talk about this in detail in terms of how you can do that within Quantum and within Quantum Mutual Fund. So the first aspect of that 12 months, and this is relevant to what the impact on the budget also, is keeping the money in a safe position. And in our sense, we say, you can keep it in a liquid fund. And as I talked about fiscal deficit, so when fiscal deficit increases, interest rates increase. And we believe that RBI now, because the government is now focusing on growth, the RBI should now focus on inflation. Their priority should shift from supporting growth to supporting inflation, which would mean that the RBI will remove liquidity that they've put. So that would mean short-term rates will go up. They'll also start hiking rates, the repo rate and the reverse repo rate. You'll see them hiking interest rates over a period of time. The best way to play an increase in interest rates is what we believe is the Quantum is a liquid fund. And you can choose any liquid fund, but this is we've shown a graph of the portfolio yield of the Quantum liquid fund and the 3-month T-bill. So 3-month T-bill is a rate which is sensitive to RBI. So when RBI raises rates, the 3-month treasury bill rate also increases. So if you look at the previous cycle, 2010 to 12, as the rate in the market increased, the yield on the portfolio of a liquid fund also goes up, because a liquid fund has very short maturities and it has very low mark-to-market risk. And as the rates increase, it keeps repricing and reinvesting in higher and higher yielding assets. So when you are in a scenario where interest rates are likely to go up, this is the best way to play the rate hike cycle. Generally, we tell in a liquid fund, the objective is not returns. The objective is to keep it safe. But take an example of you keeping your money in a savings account, and the savings account interest is not going to move, right? It is typically 2.5 to 3.5%. Whatever happens with other interest rate, that doesn't move. So instead of keeping your money in a savings account, in a rate hiking cycle, if you move that money or a chunk of that money to a liquid fund, it will keep increasing higher. If you do not like to do mutual funds, then if you're doing FDs, our recommendation has been that do not lock in your FDs at these rates. When I'm saying lock in, do not do 3-year, 5-year FDs. Keep your FD maturity also short and allow the interest rate to go up and then trade. But we will still believe that this is the best way to play a rate hiking cycle. Some will say ultra short duration fund and money market. As you increase the maturity, the mark to market risk increases. Overnight funds and the liquid fund, I think, are best placed to play the rate hiking cycle. So rate hikes are actually good for a certain specific set of investors, especially for your emergency corpus. That money that you leave in a liquid fund for an emergency corpus, it will start to earn you, or as rates go up, it should start to earn you, provided the liquid fund does not take any credit risk, and it should be a safe liquid fund. So this is people know about the quantum liquid fund in terms of how it is invested. No risk, no credit risk. We only invest in government securities and PSU bonds. And the objective is very clear. Sacred money, safety first. Then there is the other side of the market, is what is going to happen to the medium tenor, longer tenor. And there, I think it will be tough. There are tough times ahead for the longer end of the bond market. You're seeing this, if you see the right side of the chart, you're seeing the spike. That spike is the movement on the after the budget. So as the government announced a higher fiscal deficit than expected, bond yields already moved up. So RBI's rate, the fixed deposit rate will move with a lag, but the bond market is already pricing in that that there will be an increase, that interest rates will increase, and they need higher interest rates to be able to buy absorb the supply that comes with the government bond. So we think there is some tough times and some volatility, and this is despite rates being high. So if you look at the blue line, which is the current, what we call yield curve, so 3-month treasury bill on the left to 30-year government bond on the right. So this is what we call that the yield curve is very steep. Short-term rates are very low, long-term rates are relatively higher. But still, because oil prices are likely to be higher, and there is fiscal deficit, and there is a demand-supply gap, we were expecting that the foreigners will be allowed to, India will get into the bond index, and that will take get some demand for Indian government bonds. That hasn't happened in the budget. So which is why we believe that if you do not have a 2-year, 3-year horizon, this could become a volatile period for medium to longer tenor debt fund. If your fixed income allocation is only for safety, it is better to be in a liquid fund.
Thank you so much, Arvind. Let me just start off with the equity outlook. Arvind has already sort of given a macro overview. So I'd rather focus on the equity strategy and what we are doing, and a brief overview of what we thought of the budget. So just to give a background of when the budget was presented, this is how corporate India was faring around the time the budget was presented. We had almost 6-7 years of virtually no profit growth. And post-COVID, suddenly growth took off in revenues as well as profitability. And in that environment, the budget was presented, and the government had to sort of take very crucial decisions. They could either cut back on the spending and ensure the fiscal is in a lot better place, or they had the option of continuing to push the economic momentum that we saw over the last 18 months. And so that is what they chose to do. So what they've done is they've continued to spend a lot more than what traditionally they would do. And most of it is via CapEx. And the objective is to try and get this momentum going. And once you set a ball rolling where you have a sort of a demand coming through, and then corporates hitting a certain capacity utilization, and then they start doing a new wave of CapEx, it becomes a circular loop. And that is what they're trying to do via CapEx, not by demand stimulus. And it's a slightly long-winded way of doing it, but the big positive remains that the surge in CapEx and the surge in government spending, which is perhaps the biggest takeaway from this budget. In that environment where the government is looking to spend a lot more on CapEx, and you're seeing commodity prices increase, which again means the commodity players will be flush with a lot more cash than they were historically, you should expect at some point a pickup in corporate CapEx cycle, perhaps over the next 12 to 18 months, and you should expect cyclicals to thrive. Cyclicals were not that much in favor pre-2020, and most of the companies were at low utilization facing weak demand. But post-COVID, things have changed dramatically. And once you expect GDP to get back to the long-term average, and you're in the early phase of the GDP picking up, you should expect cyclicals to do a lot better over the next 4-5 years than what you've seen over the previous cycle. The concerns from this budget is, of course, they have cut spends on the rural India side, which again, given the kind of population that is dependent on agri and ancillary industries, that is an area of concern. You must expect some sort of impact on sectors that are linked to that, perhaps consumer staples, perhaps a little bit of impact on two-wheelers. But given that they've cut a lot of spending there, you might have near-term impact on demand. And the other big concern that we had from the budget was, again, there is a problem on the small and medium enterprises side. I will show you a chart later on what that is leading to, but right now they have borne the brunt of the entire COVID cycle, and there is no help coming from the government. And again, even this budget was fairly silent apart from some enhancement in credit limits and expansion of some credit guarantee scheme. So really not touch that space. So I think again that does not bode well for employment in general, but you expect formalization to continue to accelerate and larger players getting larger. And again, like Arvind pointed out, inflation is perhaps a big risk. If it gets out of hand, crude goes above $100, then you should expect some cutback on consumer discretionary spend. But barring that, at least our internal view remains that India is at a cusp of a multi-year upcycle, and I'll show you strong tailwinds which are emerging for India, which makes us believe the GDP numbers as well as corporate numbers will continue to surprise on the upside. One of the big tailwinds for India is, of course, real estate. Now, real estate post 2012-13 was not in the best shape. Housing prices were not affordable, and most of the developers were saddled with debt. And by and large, prices were out of reach for everyone. But gradually, over a period of time, income has caught up or gradually it's higher. And of course, interest rates are now a lot more lower. So EMI affordability is perhaps one of the best that you're seeing over the last 20 years. And you're seeing that in the kind of transactions that you're seeing in real estate. So even if in the most recent estimates, if you go to the listed developers, say DLF and developers in the South, they are reporting record sales as well as record bookings. And we expect that trend to continue. That doesn't mean real estate prices will go up dramatically, but just that transactions will happen a lot more, and excess inventory that was there in the system will get absorbed, and you should see a lot more supply coming through. What that means, so real estate itself is a big driver for GDP growth, but what that also means is once you buy a house, you fill it up with furniture, you fill it up with consumer durables, you fill it up with, you perhaps buy a two-wheeler or a four-wheeler for mobility. So it creates a large multiplier effect, and real estate is one of the key variables that is changing for India over the last 12 months that we are seeing. And we expect that will accelerate GDP growth over the next few years. The other big tailwind that is coming through for India is hiring in information technology. And it is one of the strongest that you're seeing over the last almost 2 decades. Now, people who remember the 2003 to 2008 upcycle, one of the big drivers there was strong hiring in IT and strong wage increases in IT. And there are research that suggests every 1 job created in IT creates 4 jobs in the other parts of the economy. And given that we are seeing a strong surge in IT hiring and the demand environment is expected to remain robust over the next few years, we expect this trend will continue to remain strong, and it will create very strong multipliers for the economy. Again, these are very high-paying jobs. These are not sort of low MSME kind of jobs. And again, it will act as a very strong catalyst to pull up GDP growth back to the long-term average. So what that means is earnings cycle will continue to surprise on the upside. Post Q1 of FY21, where analysts, after having cut the numbers quite sharply, started upgrading the numbers, that trend is just continuing. We expect this trend to continue over the next 3-4 years. GDP numbers as well as earnings numbers might continue to surprise on the upside compared to what the analysts estimate. I used to be an analyst in 2004, and in that upcycle from 2004 to 2008, there was rarely a quarter where I was not upgrading numbers for companies. And our sense is India will again get back to that kind of upcycle, and you should expect earnings to surprise on the upside for most companies, especially for cyclicals, as you have a broad-based economic recovery. I think most companies will surprise on the upside, and that earnings trend will continue to move higher. This trend will continue perhaps for the next 3-4 years, and you should expect elevated earnings growth for the next 3-4 years. In terms of how we are positioning the portfolio, again, it is positioned for an economic revival. We have very large weights in sectors where we think it will benefit from a strong, broad-based economic recovery. We have large weights in consumer discretionary, financials, materials, and utilities. Barring, say, technology, which is primarily linked to sort of the global uptrend and demand from the West, most of the other sectors are linked to domestic revival. And these are the sectors where we think valuations are still reasonable, and we believe they will do well over the next 3-4 years. So at least internally, the portfolio is positioned for an economic revival, given our view that next 3-4 years will be very strong GDP growth for India. Not only is it positioned for an economic revival, but we are also careful that we are picking and choosing companies which can handle interest rate volatility a lot better. So barring financials, where we think these are very well capitalized banks or companies which are sovereign owned, where they do not have any problems of access to capital, the portfolio remains very, very low leverage. And utilities, of course, they need to have high debt equity ratio to get that 15% return on equity. But barring that, we have companies, 13 of the 28 companies are net cash, and the remaining 6 are less than 0.4 debt to equity. So not only is it geared for an economic revival, but we do not expect any major implication of interest rate increase on their books, given that they are very low leverage companies. I mean, one of the big concerns people have is on valuations. Now, the earnings are relatively suppressed because we continue to have these multiple lockdowns and unlock period. So the business cycle is still not normalized. As you normalize, the earnings number will catch up. So that will automatically get P lower. But in an environment where earnings are showing a very strong upcycle and liquidity is relatively easy, not as easy as it was around the COVID period, but still central bankers are leaning towards growth rather than tightening in a very severe way. In that environment, I do not expect P multiples to correct very sharply. We should expect P multiples to remain elevated. What will happen is earnings growth will outpace P expansion, or P's might stay where they are. So in that sense, you might expect an automatic correction in P as earnings growth move quite higher. So our sense is P will remain slightly elevated and earnings growth will outpace stock price returns over the next few years, but it will still be fairly decent stock price returns. Not, of course, what you've seen over the last 18 months, but better than alternates available. Perhaps high single digits to low teens kind of returns you should expect over the next 2-3 years. Of course, we are value, and the other way of trying to protect the value from high multiples is to build a portfolio which reflects value. And of course, our portfolio is, again, 34% discount to the index valuations, and our PEG ratio is a lot better than the index. So in that sense, it is also offering a downside protection in case there is some global dislocation. This is a value portfolio, and we think value style will do well over the next 3-4 years. And I'll tell you a reason for that. But for people who are looking to play sort of the economic story over the next 3-4 years, value perhaps is a much better way to play that story than the traditional growth stocks that have done very well over the next 4-5 years, over the last 4-5 years. I mean, I know values stocks have not done that well over the last 5 years, and it's been a technology story, but all that is reversing very quickly. And we're seeing sort of glimpses of that in the month of Jan. People who remember the 2003 to 2007 story remember how well the value stocks did compared to the growth stock. And again, our thesis is India is getting back to that kind of story. So irrespective of what happens in the West, I think there will be a broad-based recovery in India, and in that broad-based recovery, value will do really well. And of course, the quantum long-term equity value portfolio, which of course last few years had a tough time in a growthy environment and a frothy environment, we expect it to get back to its long-term outperformance. So for all investors, we recommend 15% of their equity allocation should be in the quantum long-term equity value fund. So if you go to the dashboard and you look at the allocation, quantum equity value fund is recommended to be 15% of your long-term allocation. And the balance 85% is expected to be in fund of funds and the quantum ESG fund. And of course, I now hand over to Chirag to explain to you how he is looking at the market for the other 85% of the equity allocation and the 20% of gold allocation. So Chirag, over to you.
Thanks, Nilesh. So overall, what Nilesh and Arvind spoke about, that barring despite the budget not supportive of consumption growth, still we have strong tailwinds that will support the economic cycle that we have going forward. And with that, although the capex government's pushes towards capex, sectors like materials and industrials, which are cyclical, that Nilesh pointed out to, will do well. And over a period of time, as government spends, government spending will be someone else's income. There'll be jobs being created, and that will, over a period of time, hopefully drive the consumption story as well. So three sectors that you could look forward to, which will probably do well: materials, industrials, financials to an extent, and the lagged effect coming in the consumer discretionary sector. So overall, we do see a strong push towards infra projects, a strong capex, which will drive a kind of front-ended performance in these kind of sectors, and a lagged performance in consumption-driven sectors. So with that, the bulk of the equity exposure, we recommend that to have in the quantum equity fund of funds, because it is a more diversified exposure that you get. You get different styles within it. As Nilesh pointed out, that there is likelihood of value doing well. So it is very difficult to point out which exact style will do well in which kind of scenario, because there are various variables, various kind of factors that impact performance of different styles. So to have a diversified exposure is always recommended. And if you look at the quantum equity fund of fund exposure today, it's there in the right sectors. If you look at the materials, it is at par with the index. Industrials, it is significantly larger allocation as compared to the index. Consumer discretionary, which will also see that growth coming in, is also higher as compared to what is there in the index. Other sectors like technology, or be it financials, it is also adequately positioned in those sectors. Technology seeing global tailwinds for that sector, global growth being driven, or technology spend being driven by the pandemic-induced era. And we are seeing some serious business for such kind of companies. And also for financials, if credit growth picks up, there could be a larger business for financial companies. So overall, if you look at quantum equity fund of fund current position, is also very well poised to benefit from the economic growth revival that we're talking about. Although if there were going to be consumption boost, again, it will further benefit. But currently, if you look at how the economic cycle is poised, I think it is very well positioned to benefit. So a large chunk of your exposure towards equities has to be quantum equity fund of funds. If you have lopsided allocation, you can go to our dashboard. It'll give you the right allocation, and you can just do it with a few clicks and rearrange your portfolio. And this could be the right time to do it. Other area of the market, which is a green economy, or be it the socially conscious economy, which is also growing significantly. And there has been a global push towards ESG kind of investing. So this budget, if you have heard the speech of the finance minister, so the word sustainability was spoken about many, many times. The main PM Gati program that they have, the master plan, it also is powered by clean technology. So there is going to be a thrust towards the green economy, towards being socially conscious, because that is where India has pledged to kind of reduce its carbon emissions, to meet the social development goals. So there has, it is kind of a bigger thrust area, not only for India, but also globally. So there are many positives. They kind of reduced or made a single window for all green clearances, which will mean less bureaucracy. There is a thrust on clean and sustainable mobility. There is a greenification of mass transport. That is where the focus area is. The battery swapping policy is a big positive. It could drive, it could give a big push to the EV if it is formulated and executed well. Today, the bigger hindrance or anyone buying an EV car is that if I go out and if the battery kind of dies down, what happens? So people have that hindrance So if there is a battery swapping available, so it will take, I think, equal or lesser time similar taken for you to fill the petrol tank. So it could be just the battery taken out of your car and new battery put in, which could be at various centers or various petrol stations. And that could remove a big hindrance towards EV implementation that we are looking for. So I think there could be a bigger push to EV. It's clearly on government agenda. Another important positive is the PLI given to solar module manufacturers. This will reduce our dependence on imports and allow that sector or allow solar energy generation to go up significantly. There is a push towards circular economy, which means that more recycling initiatives to be undertaken by companies. They have earmarked 10 sectors. So circular economy is getting that push that was required from a regulatory perspective. They are trying to transition towards carbon neutral economy. They are trying to put in a few projects on a smaller scale. And if those projects succeed, they will implement it on a larger scale basis. So there is a clear thrust on reducing emission at the manufacturing level. And there is things about sustainable financing. So they have brought green bonds into the ambit. The government will issue green bonds, which will help them raise low-cost financing to meet the climate goals that we have. So these are the good points, but what it missed was, one is there should have been more incentives towards green investments, which is something that we kind of found missing. There should be research and development incentives that should have been given. Most budgets previously used to kind of encourage needed sectors towards R&D, but here we don't see much incentive to green tech research and development, which is kind of a little daunting. There should have been more encouragement to that sector. Another thing missing was a carbon tax or a reward for companies who are already doing much more on that front and trying to reduce the carbon footprint, becoming better at water waste management. So that was missing. But there is a clear thrust on sustainability. I think government should have done more in terms of giving out a strong signal globally that it's not only words, we are putting our money behind it. So that money element is something missing, though the goals are very, very ambitious. We could clearly cite a vision on sustainability, but there was lack of follow-through action from a financing perspective. So overall, there is not enough spending, nor much incentives. If you look at expenditure towards environmental activities over last 2-3 years, it's more or less flattish. It's growing by small bits and small bits. It's not a large thrust even on the social activities. I think these kind of activities need to be front loaded rather than, because these projects do have long gestation periods. So to meet the goals that we have pledged for 2030, I think we need to front load it and also reward. It's not only government. Government can do some heavy lifting, but they need to bring in the private sector and reward companies or tax companies who are not really doing much on their ESG practices. So I think over a period of time, we will see that happen because we are losing time as we don't implement it in a very bigger way. And as we lose time, there will be forced regulations on companies to kind of get their act together. So all those good companies, good ESG companies who are already doing well, will have that benefit when those regulations unfold. And that is where the long-term story of ESG will play out. And if you look at today, even today, the cyclicals that we said will probably do well. If you look at the ESG equity fund that we have, is very well positioned to even benefit from the cyclical story that we are seeing, or the tailwinds to the economy that we are seeing. If you look at the material sector, like cement, steel, etc., which will be in demand for its products, because infra will require all those raw materials to build in, right? So if you look at the material sector exposure, be it chemicals or be it cement, be it paints, etc., and the housing boost that we are talking about in terms of affordable housing, we are significantly overweight to the material sector. We are overweight to the industrial sector. And as consumer discretionary or consumption will pick up over a period of time, we are also positioned well in that sector. So overall, we see the right levers and the portfolio be positioned in a really right manner, even in the ESG fund. And also the long-term story about the sustainability thrust, more regulations, more global best practices being introduced. Companies who are already ahead of the curve will benefit sooner or rather than later because of their ESG thrust that they have in their practices. So overall, that equity portion that we were talking about has to be split between 70% of your equity exposure towards quantum equity fund of funds, 15% to the ESG fund, and 15% to the value fund. If it is not positioned in that manner, you can go back to our dashboard where you will see where the mismatch lies in your portfolio, and you can easily do it with a few clicks. Coming to one more strong pillar of your portfolio, that is gold. What did budget do in terms of for gold? There were some introductions on the crypto tax. What does that mean? So there was no reduction in custom duty, although there was a demand that government should rationalize customs duty. Today, the differential between an international gold price and an Indian gold price is 14%, main being the customs duty and then the GST. So there was no reduction in custom duty. This only adds to distortion, and hopefully over a period of time, they should cut the customs duty. But for now, for you as an investor, it does not make a difference because customs duty is what you pay while buying gold, and when you sell, it is also part of the price. So there is no loss for you on account of customs duty today. Only if customs duty changes up or down, that may lead to a difference. But today, your portfolio value remains the same. You're buying at the same customs duty, so there is no change for you from a gold perspective. There was some boost to gems and jewelry sector by cutting customs duty on diamonds. Also the capex that they have announced could in turn have an inflationary impact because raw materials will be consumed for that capex push, which could lead to some inflation when inflation is already running hot. That could also, and we have seen time and again that at times of higher inflation, gold as well. So that could benefit gold because there could be, and also the tightening cycle in the US that we are seeing could lead to a weakness in the rupee, plus the impact on higher inflation and higher fiscal deficit be reflected in the rupee. So that could mean positivity for gold to some extent. Another important thing was about the crypto tax, crypto being taxed at 30%. There are many who kind of say that now crypto is being legitimized, but it's not recognizing crypto as a legitimate asset. It's just bringing the gains from crypto, which were not taxed or there was not clarity earlier, has been brought into a tax bracket of 30% plus a TDS of 1%. So, so when it comes to your portfolio, cryptos do not have intrinsic value overall. And from a portfolio perspective, given the volatility in cryptos, given that there is no way to value cryptos, given the lack of intrinsic value, so many cryptos out there where to invest, where not to invest. So it doesn't make a very good investment for you. From a diversification perspective, gold is still the best diversifier available for your portfolio. So have a 15% allocation to gold at all times. And currently, if you see, gold is in a consolidation period. We are seeing consolidation in prices after reaching that 56,000 rupees per 10 grams. Gold had corrected to about 45,000 rupees and now consolidating in the 45 to 50. Time and again, we have seen that such periods of consolidation are usually good to accumulate gold for your portfolio and build your allocation. So these are the times when you should kind of build your allocation. You don't know where the next risk can come from. Although equities look better, a way to diversify away from your equity investments is to have an allocation to gold. If equity is kind of tumble for some or the other reason, gold would be an instrument that will likely protect, as it has done historically, on your portfolio. So I think use the corrections, use the consolidation in gold to build your allocation to your portfolio. It is a must-have. You don't know where the risk will come from, and it will be a helpful asset during such times. So I think you could take easily the building blocks that you have and build your portfolio easily. Like Arvind mentioned that, it's a very simple way to have a no confusion oriented asset allocation in place. You could just follow this 12, 20, 80. We have seen it work time and again in all time periods, be it a crisis period or be it an up market. It has kind of helped well to not even only protect downsides, but also capture the upside potential of an economic growth. So I think you should try this 12, 20, 80. It has worked wonderfully, as I've said, and it will make investing much, much simpler for you. So you could go to our website. There is a dashboard available. It tells you where you are invested today and what your investment should be. It is just very, very easy. Although this is simpler, rebalancing your portfolio or changing or tuning it to this 12, 20, 80 is even made simpler on our dashboard. So I urge you to kind of try it out. And I think your investment journey, which will be far, far simpler from here. So this is how the dashboard looks like. It will give you a glimpse of where your portfolio is today and where your portfolio should be as per the recommended allocation of 12, 20, 80. With a few clicks, you can make your investment very, very simple. So with that, we will be happy to take questions, and over to you, Sandeep.
Thanks, Chirag. Thanks, Arvind. Thanks, Nilesh, for the presentation. We have some questions people have written to it, and there were some questions before the webinar. Our investors had requested us to take this, some of it. Yeah. So this is to you, Arvind. Your views on India becoming a $5 trillion economy on this by 2026. What's your view on that? In the first slide, you showed that the GDP was on a declining graph. So how do you take it?
So every government will have some targets and some goals. So I think this government decided that in dollar terms, India should have a 5 trillion. India should reach 5 trillion. I think the initial was 2024, but of course with the pandemic, it's been pushed back 2 years. If I have to answer only that question from a mathematical perspective, it looks difficult because from here 3 years on, 4 years on, it requires a dollar, because $5 trillion, right? So in dollar terms, it requires about 14% compounded every year to be able to get to that 5 trillion. So maybe that might not be easy, because if I look at historically in dollar terms, so Indian nominal GDP in rupee terms, say kind of averages about 11.5 to 12.5%. And then over a long period of time, Indian rupee depreciates against the US dollar by about between 2 and 3%. So dollar GDP grows at about 9 to 10%. So expecting it to grow at 13, 14%, maybe slightly optimistic. Having said that, so that 5 trillion is just a number, right? India will reach that number someday, maybe a year early or a year late. That's fine. But the way to see from an investor perspective is what kind of opportunities it creates, right? So as incomes increase, so when GDP grows, what it does is it creates production, it creates income. So people's incomes increase, right? At the end of it, that's what matters. And as incomes increase, demand for various other items changes, right? And that is the main thing. That's why the growth is so important, because India is still a poor country, or poor to low income country. And as the GDP growth increases, it creates opportunity. So that's why when we talk about the potential of the Indian economy, it's not only 5 trillion, right? If I look at a 10, 15, 20 year potential, we know that India is still a young country. There is so many infrastructure yet to be built. There are so many different companies that are yet to be built. And as we are seeing today also, so many new entities, new businesses, new ideas, new technologies are coming about. And all that creates opportunity. So the government's role from a target perspective has to be to ensure that they create an environment where private individuals or private companies can function, invest, and their job is to ensure that regulations are such that they facilitate it. And the only focus of the government should be jobs, because that is the only long-term risk that India has. That young country, educated workforce, if they do not have jobs, then you have a social problem in your hand. So targets are good, but the potential is a lot more.
Lauren, do you think currently there is any uncertainty right now around?
Uncertainty on what?
Currently any economic uncertainty right now, or is it a prolonged one?
So if I look at in the short term, as I said, the most long-term risk that India has is jobs, right? In the short term, oil prices tends to be India's biggest bugbear, as we call it, in the shorter period. So when oil prices go up, it creates multiple problems. It increases our trade deficit because India is importing almost the large part of our oil is imported. So it increases our trade deficit, which means dollars go out. We need more money to be able to pay for that imports. And when it comes in, there's a price increase, right? And now there's a complete pass through. Plus the government is adding on tax on it. So the price of their oil prices go up, so inflation goes up. If the government does not want to pass the inflation and reduce the price, then they take a hit on the fiscal deficit. So the fiscal deficit increases because they will cut back on taxes and still spend. So that's why oil prices tend to be a big macro. So during 2014 to 19, we had a very great scenario where oil prices were going down. And that was a big macro tailwind. Now when oil prices are going up, it will become a huge macro headwind. So I think global inflation, and for India specifically oil prices, I think they need to worry. The other worry that I said was India has also increased a lot of import duties, right? With the objective of encouraging domestic companies, make in India, PLI, supporting that, which is good. But in the short term, until the time that those supply comes in and those companies invest and produce the products, we might be entering into a scenario, given the global inflation and the high import duties, we might be in a scenario where domestic inflation could be slightly higher, which could impact profitability of companies, which could impact the extent of interest rate increase that the RBI will have to do. Those are the two short-term risks, oil and general inflation.
Yeah. So Arvind, since you touch even the interest rates also, has the budget failed to cheer the bond market? What's your view on that?
Yeah, so as I said, the government is prioritizing growth. So when they prioritize growth, they have to deprioritize something else, which is the fact that the government does not have all the revenues, right? So government is spending 40 lakh crore and is going to get revenue of say 23, 24 lakh crore. So there's a 16 lakh crore gap, which is getting funded by the bond market, that is what is called the fiscal deficit. 70-80% of the fiscal deficit of the government is funded by issuing what we call government securities, the government bond market. The rest is funded by small savings, national savings certificate, post office, Kisan Vikas Patra, Sukanya Samriddhi. This is the way the government finances it. So the larger the gap between expenditure revenue, the higher is the fiscal deficit. The government is clearly taking a view that I want to spend first and then worry about debt. So it has to pay a cost for it, right? And for lunch is not free, as they say. Last year, there was RBI support. RBI reduced interest rates and RBI also increased its own borrowing. So government was borrowing more and the RBI supported the bond market borrowing program by buying government bonds. This year, the expectation is that the supply is larger. It is higher than last year. And the support by the RBI is going to be less. So that's one worry. Second, I told you about foreign index. Like India was supposed to get included in the bond index. There were some announcements to be expected. That's not happening. For the last 3-4 years, foreigners have been net sellers of Indian government bond. They already own very little, but they have been net sellers. So even though limits are available for foreigners investors, they are not investing in Indian government bond. That's an area of concern. So who's going to fill that gap? So either the gap has to come from RBI or foreign, or the existing investors will say, I will not buy for 16 lakh crore of fiscal deficit at 6.5%, I want 7.5%. So rates will go up. And that's what is happening currently. You've seen a significant increase. The RBI will try to manage, they will talk, they will cancel some auctions, they will do some OMOs. But given the fact that this fiscal deficit is high and the demand is lesser, you should expect interest rates. That's why, as they say, bond markets have not been very happy, which is the medium to longer tenor segment of the bond market. And as I explained before, interest rates increase is not only a bad thing. So what happens in a bond market, in the bond fund, is when interest rates go up or yields go up, the bonds fall in prices, and that's why it gets impacted in your NAV. So typically, if you look at the long-term, long duration, long gilt fund or dynamic bond fund NAV over the last week, it would be a significant negative number. And which is why we say that if you are investing in a bond fund, have a 2-3 year horizon, because that's how the interest rate cycle plays out. And only after 3 years, this capital gains tax benefit becomes kind of better or attractive as against fixed deposits. But as I said, the other way, when interest rates go up, there is a segment of the interest of the mutual fund market, which is a liquid fund, overnight funds, money market, short term, which benefit when interest rates go up. So that's how you need to think about it. So some segments will be unhappy, the longer tenor, and there's a genuine risk there. Some investors segments should be happy that, as interest rates go up, their returns on very low risk liquid fund kind of products will increase.
So thanks.
There was a question on the chat on savings
so,
account and liquid, and I'll answer that because I'm answering it. And that was true. We actually ourselves gave a recommendation that because liquid fund returns are so low, you could just leave your money in savings account. Yeah. But as I showed in that chart, when interest rates goes up, the savings account will remain at that level, right? It's not going to change 2.5%, 3.5%, depending on which bank. Some banks are giving higher. That's a different point. But the liquid fund returns, although we recommend that do not look at returns when you invest in liquid fund, but the liquid fund returns will increase as interest rates go up. So savings will remain the same, and liquid funds will move. So we are now recommending that if you have a lot of money in a savings account, keep some emergency corpus or liquid, and then the rest you can move to a liquid fund and benefit from the rise in interest rates.
Thanks, Arvind, for touching that, because asset allocation, we tell people to keep 12 months of emergency money into liquid fund, which is very necessary for retail investors. In fact, bond may be a product for some institutional investors. Yeah. So this another question. This is for you, Chirag. In fact, how does an investor address an INR depreciation? Since if we analyze the real returns in the Indian markets, the Indian market returns may be negligible. So is fund of fund a better option? Maybe I think the investor wants to ask a fund of an overseas is a better option.
So if you look at the rupee, we have seen a depreciation over long time periods of, like Arvind mentioned, 2 to 3% per annum. So overall, the way to kind of protect or ensure that you kind of price that rupee depreciation and benefit from your investment is to either, one is very, very simple, have an exposure to gold. Gold will provide you, because gold prices are a function of international gold prices and the rupee rate. So as the rupee appreciates, your gold price will appreciate by that much amount. Second is way to have diversification to global assets, be it global fund of funds or global allocation, be it equity or a multi-asset or any of that sort, because those you are investing outside India, and when you convert back those assets to Indian rupee, you get that rupee depreciation benefit. So those are the two big ways to play out that, either through gold or either through a global investing. When it comes to, if you look at any global index over long time periods, like 20 years or so, Indian markets have done much better than the global indices. So if you're asking me to choose between Indian asset versus global asset, like a global fund of fund versus an Indian fund of fund over a long time period has given better returns than the global funds. So Indian Indian assets or Indian fund of fund is a better way to play that out. But we always suggest diversification, so you can carve out some exposure to even global investing, which could be helpful to mitigate that rupee depreciation exposure. Plus your gold allocation will also help you to do that. So a big chunk still has to remain your Indian equity assets, a small chunk like 20% to gold or out of that, some chunk you can carve out from that gold exposure or from that equity exposure towards global fund of funds. Because today Indian markets are doing well. What happens if Indian economy or Indian markets don't do well? Then in that case, you have a stream of cash flows coming from your investments overseas, which will help you diversify and also help because of the rupee depreciation. So a big chunk in Indian equity fund of funds or Indian equities, and a small chunk to gold and overseas fund of funds.
Yeah, thanks. Thanks, Chirag. Chirag, so there is a question on asset allocation. In fact, in our communications, we have always told people to stick to asset allocation.
Yeah.
Budget is a thing which the retail investors normally think is maybe a situation or an opportunity to correct or look at their portfolios. So for the benefit of our investors, can you tell how wide should they stick to the asset allocation or to the suggested allocation, even though there may be events coming in their portfolio right now?
Yeah, so I think budget should not alter your long-term allocation. There could be some opportunities like what we if it is a capex driven budget that we are seeing today, it could help further improve equity returns, because if you are positioned in the right sectors, it could help you to generate that return from your equity asset, right? So budget could be a good time because it kind of helps or derails some asset class at some point in time. But over a period of time, its relevance has gone down. And it's so many things are done outside the budget as well from a reform perspective. So I don't think budget could be the right time, but this time the budget has given you that impetus that it has not derailed equity as an asset class. There are no burdens on any companies or be it on the consumers. So overall, it helps you to focus on this 12-80-20 in a larger way, because equities seem to be having tailwinds behind it. There is nothing to derail it. So if you don't have that 80% allocation, this is a good time to rebalance that and achieve that 80% allocation. But I don't think you should see budget from a perspective of changing your asset mix. This is a very long-term asset allocation that has worked through many cycles, and that is why we have come forward to suggest that. And if you follow this, be it a capex-led budget or a consumption-led budget, I think this will not hamper in a big way. But this budget otherwise has given you an opportunity that if you're most of the investors are not so much into equities, such large investments into equities. But I think given the supportive nature of the budget in terms of not derailing the tailwinds that we are seeing, you could make the switch to this large allocation that we are talking about.
Thanks, Chirag. Chirag, also we showed some economic indicators in our presentation. Now, this may be common to all EMCs, but Quantum Mutual Fund has a different approach. We are telling our investors to stick to 12-20 approach. So why is this difference between Quantum EMC and other EMCs?
So, the economic landscape remains similar for everyone. I mean, everyone is viewing it from a similar lens. Probably that is why you see even the equity fund of funds being positioned in a similar way in terms of heavyweight towards industrials, heavyweight towards the cyclical stocks. So what we are saying is, irrespective of the budget, I think the 80% exposure that we have towards equities is good enough exposure to kind of ensure that you take advantage of the upcycle, the tailwinds that we are seeing for the economy. Like Nilesh pointed out, we are seeing a similar cycle, what we saw from 2003 to 2006, 2007, it looks like. So to benefit from that, I think that 80% is a good enough exposure. Like we have seen in previous cycles, also the bull cycle of 2003 to 2007, if you had this kind of allocation, you would have done better. And the other allocation to have 12 months expense into a safe liquid fund, or be 20% exposure to gold, is from a role that they play within the portfolio. It's for stability, for diversification. And therefore, this 12-20-80 still will work. And it has worked across timeframes. And even this time, we think that it will work. So within the components of equity allocation, is the funds being oriented in the right way or not? We showed you that sector allocation of all the 3 funds that we have, and they are positioned in the right manner. So I think you should still stick with this 12-80-20 and ensure that the fund managers are doing the job in terms of navigating the cyclicality of markets to their advantage.
Thanks, Chirag. So Chirag, it was a question from our investor, and he would also like to understand, since 2006 we had different products, and with this strategy going ahead, what's your view on the growth of quantum mutual fund?
Yeah, so I mean, we want investors to really understand our product, understand our thesis, understand our suggestions around this asset allocation approach that we have, and then buy into our funds. We don't want to push it aggressively and have you buy without understanding the products that we offer or the allocation that we offer. So we think that our growth is going to be there because the approach that we have towards asset allocation, approach that we have towards managing this schemes with a research-backed approach is working well. Though our flagship fund had, last 2-3 years been challenging time for value, it was a challenging time for that fund as well. So, over a period of time, as we have seen, we are giving good solution-oriented approach to investors, having the right mix of allocations. Despite the 70% of equity that we are suggesting to quantum equity fund of funds being managed by external investors, though it is in the interest of investors, we are advising that higher allocation. So I think the investors will understand and buy into our philosophy, and we will have that growth. Eventually, growth will come. It's just a byproduct of the good things that we keep doing. So we will keep doing the good things, and we will see growth over next few years.
Thanks, Chirag. Thanks, Chirag, for that. Nilesh, this is for you. Do you see the markets correcting in the near future, or are value stocks seeing comparatively a better correction?
So there are events unfolding globally where interest rates are heading higher, which might have some implications for flows in emerging markets. And you saw some evidence of that in Jan, where there was some pullout and that led to a correction. But again, our sense is, given where India is positioned on the economic cycle, even if there is a correction, it will bounce back. In the end, equity prices will follow earnings. And given that our outlook for earnings growth is very, very strong, at least our expectation is if there is a correction, it may not be that meaningful, and India will bounce back for sure. We will get back to, we will recoup most of the losses and head higher. So barring any major dislocation globally, I don't think there are reasons for India to correct materially. I mean, crude is one factor which might spook a lot of people, but I think Indian companies can manage it. I don't think it's that big a concern. Value for sure. I mean, if you just look at the January performance of the long-term equity value fund, again, in the down market, we corrected a lot less. And of course, we rebounded a lot higher and the market moved higher. So in that sense, value style and quantum long-term equity value fund has done a lot better. And our sense is, like I said, our belief is if there is a broad-based economic recovery, the value style will do a lot better. And within that, the quantum long-term equity value fund, which of course last 2017, 18, 19 had a tough time in a very limited growth environment, will do a lot better in terms of return profile and outperformance. And we hope it gets back to its long-term outperformance, which we saw before that 2017, 18, 19 period. Certainly, we are hopeful. We think markets may not correct that materially, barring any major global dislocation. And the value style for sure will do a lot better over the next 4-5 years. And within that, the quantum long-term equity value fund will do a lot better.
Thanks, Nilesh. Chirag, we showed 20% allocation to gold. Now people can buy gold through an ETF. They can buy through a quantum gold savings fund. They can also buy a digital gold. Sure. And now, if I buy digital gold, will it be taxed as 30% now? Because it is also a virtual, instrument now.
Yeah, the idea behind the taxation of virtual digital assets was more to tax crypto-like assets, because digital gold was already taxed before also. So it was taxed because the way the digital gold is kind of structured, it's like saying that you the investors own the gold, and it is just kept as a digital asset in a safe custody. So overall, it was already taxed like physical gold. The idea, I don't think, is to tax. I'm not an expert on taxation, but to what I can read so far is that it is more towards taxing crypto-like assets, and digital gold, given it was already taxed before, like physical gold, and it's treated like physical gold. I think that's not going to be under the ambit of virtual digital assets, probably. So coming to the exposure to different types of gold, be it SGPs, be it digital gold, be it physical gold, there are nuances and differences between all three of these. SGPs are backed by a government guarantee. There is no gold backing to those units. They do pay you tax interest. So from a returns perspective, they are higher, but they don't have a gold backing. There is a set of investors who believe that they want a gold backing to what they buy into, and therefore they prefer ETFs or gold funds for their exposure. Digital gold is not regulated by any regulator, so it is not regulated instrument. It is issued by the companies through whom you buy gold. They are supposedly backed by physical gold. One thing important between gold ETFs and digital gold is one is digital gold. You kind of compare the prices, they come at a markup over and above the gold prices, whereas gold ETFs or gold funds are available at very, very wholesale, close to wholesale market prices that are there. So you don't pay that high premiums or high markups involved in physical gold. Second is on the taxation perspective. Given mutual funds are pass-through vehicles, when we buy gold, we pay GST on it. It stands as a credit or a current asset in the books of the scheme. And when we sell the gold because of your redemption, there is an offset which is available to the mutual fund because of the input or the GST paid at the time of purchase. So you don't lose out on the GST you have paid at the time of purchase. It comes back through you because we get that offset benefit. Whereas in a digital gold, you don't get that GST benefit. The 3% that you pay at the time of purchase is lost. You don't get it when you sell the gold. So one important distinguish is unregulated instrument, which is digital gold. And second is loss of GST is a big thing. Plus the markups involved when you buy that digital gold is something that you will have to be concerned about.
Sure. There is a question from one of our investors, Ashish Goel. Now, Arvind, you can help us with this. Globally, if you see the inflation rates are very high, and in one of the slides, you also showed that India being a favored destination for the investments also. So how do you see the investments in the coming years in India, and how does it go?
If it's a very broad, if I look at, now let me take global investors. Right? So if I look at global investors, and I consider, say, pension funds, sovereign wealth funds, global asset management companies, like, the big mutual funds, endowments, foundations, insurance companies. If I take their total allocation, total assets, they have about between $250 to $300 trillion under management. That's the amount of money that these global institutions manage. And if I look at the investments in India, if I look at equity, just public equities, it will be about market value to about $650 billion. If I add private equity and venture capital, you take another $300-400 billion. Debt is very limited, $30-40 billion. So the global investor is under allocated to India in a big manner. So if India will become the third largest economy in some years and will become the second largest economy in another 30-40 years. And the global investors will have to get allocated, right? They won't have any choice. If they want growth and they want that higher returns, which India kind of has the potential for, their allocations will increase. So that right now they're under allocated and they will increase their allocations. So also India is large, right? We're already $3 trillion, will become $5 trillion as the question asked, and then will become larger. So India also has the capacity to absorb that capital across equities, private equity, venture capital, fixed income. There's such a scope for foreign investors to invest in Indian fixed income, right? So a real estate, infrastructure. So that, if I look at from that zoomed out perspective, the potential is immense. All we have to do is to get sane policies. Do not come out with things which scare investors. Encourage them. You don't need to mollycoddle. You don't need to give too much incentives, but just have steady policies over a long period of time and create mechanisms where you can absorb that long capital. That's the long view for it. In terms of inflation, again, today we are seeing global inflation is a bit different. Like in the US, it's 6-7% inflation, whereas the target is 2%. In India, we are seeing 5.5-6% on the CPI, and our target is between that 4 and 5%. So because food prices have behaved itself, it hasn't increased by much. Some aspects have gone up, some aspects have come down. Indian overall inflation has been lower. Also, the consumption demand itself is weak, right? People are still, unemployment is still only just going down. As we showed in the chart, that income and consumption is not being boosted. There is, people have still lost income. So that demand impulse also is lesser, as against globally, where as the pandemic happened, all global central banks or governments, they spent money on people. Like if you have lost your job, here is a paycheck protection. If you've spent on health, here is a subsidy for health. They have increased consumption, which is why they are seeing high inflation. India recovery is mostly from the supply side in terms of companies and export. It is still not as much as demand. So demand is still weak. That's why Indian inflation is still under control. It might change, but as of now, lesser of a worry.
Thanks. Chirag, this is for you. So if I visit Quantum Mutual Funds dashboard or asset allocation strategy, you see 70% of the portfolio is into fund of fund. Now, fund of fund inherently will have its parent expense ratio, and the underlying funds will have a own expense ratio. So does it make sense for an investor to have a double expense ratio, and why is it necessary? And also it contributes around 70% of your suggested allocation strategy.
Yeah, firstly, it is suggested to have such a high allocation because that's one-stop solution where you get exposure to diversified equity styles of investing, right? You have many other fund managers out there who are good, smart, doing their work in terms of getting that performance consistently over long periods of time. So you bank on those fund managers to get you that equity returns that you're looking for long-term growth. So I think it is meant to be, because it's just an extension of why you invest in a mutual fund, right? You invest in a mutual fund because you do not have time, inclination, expertise to buy stocks yourself, and therefore you bank on a fund manager to do it. Similarly, when you invest in an equity fund of funds, you to identify out of that 500 schemes, which 5-10 schemes to invest into and build your portfolio, track those diligently over month on month or on a periodical basis to identify who are consistent performers. You may look at ratings, rankings, you can look at top funds today, but if you look at top funds today, they might not be the top funds tomorrow. We have seen that inconsistency. So out of that inconsistency, how do you derive those consistent fund managers to get you that long-term investing, and therefore that long-term returns that you're looking for is very, very difficult. So for all those who do not have time, expertise, inclination towards identifying those fund managers, you get a research-backed approach wherein we have a team where we research those funds. We meet, we do a quantitative, qualitative analysis of those funds. We look at how consistent they are. We look at various things like what is the team involved in looking after your money in terms of the research analysts, in terms of fund managers, is there succession planning or not? So we do a detailed analysis of the fund. We meet the fund managers to understand and ensure that what they say and what they do is the same thing or not. So there is a lot of work to be done, because you're handing over or investing your hard-earned money into those fund managers and to ensure that and do that due diligence so that you get the bang for your buck and help you not be disappointed with your investments. I think this is a great product for such kind of investors and a one-stop solution to investing in equity mutual funds. Coming to the expense ratio, I think expense ratio, what we do is we invest only in direct plans of the underlying funds. So direct plans are low cost, are priced very, very efficiently. And on top of that, for all the research, for all the work that we do, there is an additional expense ratio only of 0.51%. So in totality, if you look at, you end up paying 1.1, 1.2% of expenses in total of the underlying funds and what you pay for the quantum equity fund of funds, for all the research you get, for all the solution that you get for your equity investment needs. I think it's not high. For any advice that you take today and invest in regular plans, these are priced much, much higher. And if you look at the equity fund of funds in totality of the underlying and of the equity fund of funds, it's still not, it's far lesser than what you pay for regular plans. So overall, I think you're getting a solution at not a high cost. It's a very reasonably priced product. And I think with this, you don't have to worry about anything. You don't have to worry about tracking many NAVs, doing many investments. So the convenience that you get is also far, far higher. So overall, I think it's a better solution rather than you doing it on your own, or rather than going through some advice. It is more research oriented, more research backed, and a fund manager evaluating the other fund manager. I think there are lesser chances of you going wrong.
So Chirag, since we are on the dashboard and the suggested asset allocation strategy, so there is a question from one of our investors. The gold returns may not seem so good right now. The gold may not shine right now much, but still we are seeing 20%. So can you, for the benefit of our investors, explain why gold has to be around 20% of it?
Yeah, so if you look at the long-term returns from gold are not bad, right? If you look at a 20-year return for gold, it will be closer to 9.5%, 10%. So it has, the equities may be higher at 13, 14%. Gold has not given too much inferior return. It is lower than equities, but still reasonably good returns. But more importantly, why you have gold is from a diversification perspective. Time and again, we have seen when equity markets have not done well, gold has come to the rescue. It is the second engine of your portfolio. So if your one engine does not work well, it has come and supported your portfolio returns during those times. So we actually tell investors, after you invest in gold, pray hard that it collapses in value by 50%. Because if that happens, your 80% invested into equities will be doing reasonably better. And therefore, you will not mind that 20% doing not so good. But when your 80% is not doing well, your 20% is what comes to their rescue. Be it 2008 global financial crisis, be it the year of COVID, each of those times gold did better and help your portfolio during such times. So you don't know when that uncertainty will come and hit your portfolio. There are many unknowns, be it a geopolitical crisis or be it we are hearing about the conflict in Middle East, in Russia. So if something of that were to fare, there could be repercussions on all asset markets, and gold may be something that may do well during such times. So have an allocation to gold. It's more from a diversification stability perspective rather than from a return generating asset. Having said that, long-term returns from gold are still reasonable. So have an allocation to gold. And during such phases, and we have seen time and again that, gold returns come in chunks, right? We have seen gold was doing nothing before 2015, 2016, and it got a boost since then. And the COVID year, it kind of sprang up significantly. So we have seen in short periods, gold will give you that return, and then it will consolidate and again give you that return. So it's not easy to predict when that return year will come, when that uncertainty will strike asset markets, and therefore having that allocation at all times is beneficial because overall your 80% will drive that growth returns and 20% will give you that helping hand during tough times.
Thanks, Chirag. Nilesh, can you explain to our investors about our quantum tax saving fund, the performance of tax saving fund, and how it seems to be quantum tax saving fund has been among the bottom players also?
Yeah, so the tax saving fund is actually a virtual replica of the value fund. The only difference between the value fund and the tax saving fund is it comes in an ELSS wrapper. But the portfolio is identical for both the funds and the return profile is very similar. So given that value has had a tough time over the last 3 years, especially 2017 to 19, I assume, I'm not sure what the strategies of other tax saving funds are. I guess there is a growth bias there and hence they are scoring better in sort of performance of the last few years. But again, these are cycles. Like I said, if value comes back, and we saw that from 2006 to 2016, where the value strategy as well as the tax saving strategy was sort of dominating the rankings. There could be always phases of 3-4 years where we don't do that well. But if it picks up, then again, we'll start moving up the rankings. But perhaps the reason for the low rankings over the last few years is primarily because it is a value strategy in a tax wrapper, and the value strategy itself is not done that well.
Thanks. Nilesh, what's your views on flexi-cap funds and multi-cap funds?
I mean, the flexi-cap category came out of sort of some confusion about what the regulators wanted in the multi-cap category and what the fund managers wanted. So originally, multi-cap fund did not have any restrictions. The fund manager could move around wherever he wanted, and that was their definition of multi-cap. But then the regulator came back saying, no, I want equal allocation in all 3 buckets of investment. So large cap has 33, mid cap has 33, and small cap. And of course, all the fund managers who felt that was restricted moved to another category where they have a lot of freedom. But again, it is an investor's choice. If he wants a equal allocation to each category of market capitalization, he can choose a multi-cap fund. Or if he wants a fund manager to have freedom to choose and invest where he wants, again, he can move to a flexi-cap category. I don't have a view of which category will outperform. In theory, of course, a fund manager, if he has a lot more freedom, should be able to do a lot better than a restrictive strategy. But that is not always the case. Sometimes a simple strategy of equal allocation might do a lot better. So it's up to the investor where he wants to be. But my advice is the strategy that we have of 80% in equity, and within that 70% in 85% in fund of funds will cover most of your investment cases. You don't need to look at other categories to invest in. So that is my advice to investors.
Thanks. Arvind, this is for you. Your views on target maturity debt funds. How do you look at it?
So they are a good, I won't say innovation. It's a good way to, if you have a particular goal in your mind and you want some certain allocation, then target maturity funds, which is basically the fund will be like a 2045 fund. I'm just giving an example. So that fund will own all bonds which are maturing in that longer tenor, 2040, 2045. And you yourself have a target, like it's a retirement or it is child education, something. And that's and then you're allocating towards that. So it really depends on what is your objective and why are you investing. And if that matches with that target maturity, then you can do it. Globally, what has also happened is that there are multiple target maturity funds. So there'll be like a 20 year one, 25, 20, 30. And then you can make a gridded allocation saying that, okay, in the next 20 years, how much money do I need? In the next 25 years, where will I be as a citizen in my age profile? And then you can allocate it. So that's the way to play it. It hasn't picked up as much, maybe because the opportunities in India from a fixed income perspective so significant. Like apart from savings, FD, you have PPF, you have EPFO, you have now NPS, then you have Sukanya Samriddhi. There are various aspects for various kinds of investments. Plus, then you have debt funds. So maybe that's the reason why it has not been, or not too many funds have come. But as the investing matures and people realize that, okay, I need a debt allocation and I need a dedicated debt allocation, I don't want too much risk on it, then you will get this target maturity fund also.
Thanks, Arvind. This is again back to you, Nilesh. In our asset allocation strategy, we are showing 15% quantum long-term equity fund. So if I am an investor who is also investing in ELSs, will tax saving be an option for that?
Yeah, so within your equity allocation, I mean, we recommended 15% to long-term equity value fund. You can, whatever the corpus it shows up as your allocation, you can invest in quantum long-term equity value fund or invest in the ELSS and get the same strategy. The only difference is you have to live with a lock-in in the ELSS. But if you are going to invest in the ELSS, which again exposes you to the same portfolio, then the difference is then what you invest in the quantum long-term equity value fund for you to meet your value exposure. But like I said, it's an identical portfolio. So whatever is the allocation, you can either choose long-term equity value fund or the quantum tax saving fund, and you get the same return profile.
Chirag, this is to you. This is again, we answered this question last time, and you may be getting this question in a number of times. Your view on silver ETFs, should it be a part of your asset allocation at any point of time?
Yeah, so to give you the answer first and then explain it, silver ETFs should be part of the green thing on the top that you see, which is more of tactical allocation that you do. It's not a strategic allocation, it's part of a tactical allocation. And reason is, silver as an asset is more used for industrial uses, right? About 70% of the usage of silver comes from industrial usage. Industrial usage will increase when your economic growth is doing well, and your equities will also do well when your economic growth is doing well. So both in a way provide you a certain exposure to economic growth, and therefore your exposure from equities and silver ETF or silver is going to be mimicking the economic growth or economic cycle. So it doesn't give you the diversification like gold does. It is more prone towards or more biased towards how the economic growth is panning out, as opposed to gold, which is negatively correlated to equities. So look at silver from that perspective, and given that it does not help you diversify your portfolio, we are saying it's not a strategic allocation, it's a tactical allocation. Given that we are seeing increase in usage of silver from solar panel, etc. There could be a case that tactically, if you like saying that the demand for silver is going to outstrip the supply, then probably the prices may rise, and therefore it can make a small allocation saying that. But when you are investing in a commodity which is high in usage today, the higher prices are usually an issue for commodities, because that will spur substitution, that will spur saying that, this is now proving out to be costly using silver in solar panels. Can I have an alternative? Whenever there is a technological advancement, there could be an issue in terms of its usage. So you have to be very, very tactical. We have to be very, very disciplined. You should know when to get in, when to get out. Otherwise, you will stuck with a loss. So similar thing we are seeing with platinum, right? Platinum used to be expensive than gold before. It used to be at a 20-30% premium than gold. But if you look at today, given that there is a threat to the usage of platinum, because most of the platinum is being used in auto catalyst. One, it got some replacement because of palladium. Second, because of the EV push, there is an expectation that this usage of platinum as an auto catalyst will go down significantly, because there is no usage of platinum in auto exhaust systems in an EV vehicle. So overall, that will drive down the usage of platinum, and we're already seeing that reflect in prices. So you have always, when you're investing in a commodity which is high on the industrial end, you have to always say that, is this the right time from a demand supply perspective? And what are the risks from substitution? That should drive your decision to buy or invest in that commodity, and not as a strategic allocation. It has to always be tactical and disciplined allocation.
Thanks, Chirag. Chirag, another question again, going ahead on the strategy. So is the 12-20-80 strategy for retirees for them? How should they look at this?
So for every retiree, there is a different situation, right? Are you dependent on this income from this allocation or not? If this is for long-term needs, be passed on to your next generation, then yes, this is the right way to have that allocation as yet. But if you're dependent on this money to get your monthly expenses, then probably this may not be the right strategy. So it depends on situation to situation, how much you're dependent on this, how much you're not. Is it just to be passed on to the next generation? That will all decide whether it is suitable for a retiree or not. If you're not not going to be using this money, it's just going to be passed on to the next generation or your future generations, then probably this is the right way to go about it.
If I can also add, people will retire at 60, but might live till 70, 75, 80. So, there is a general tendency that once you retire and once you're, as you call, senior citizen, you should reduce equity, which is fine, but you will still need one asset which beats inflation over a long period of time. Because when you're, when you do not have normal income, then inflation matters even more, because so you need that asset. So if, as Chirag said, it is personal, but you also have to think about longevity, saying that if you're going to be 20 years without income and exposed to inflation and cost, you would still need some exposure to equities. Maybe Chirag, maybe like something like a multi-asset with an HWP or a multi-asset somehow might be a better option than doing a generic allocation like this.
Yeah, because in a multi-asset, we are kind of conservative. We play on valuations in a way. Only when valuations make sense, we'll go and participate in equity markets. So it's a calibrated approach to equity investing, and I think that will suit better rather than having such a high exposure if you're dependent on that income.
So Chirag, since we are on multi-asset, can we just brief about the multi-asset product? Because investors also do have a perception that multi-asset is a fund of fund, and in the flip side, maybe the taxation part, and it may eat up in the returns or creep up in the returns.
So I will come to the approach later. First, taxation is a myth, right? For a multi-asset or for an equity fund of funds, your minimum time horizon should be 3 to 5 years. If you're in a 3 to 5 year, because there is an element in terms of an equity exposure, a bond exposure. So it requires you to devote or give time to get that benefit. You don't know when a cycle is going wrong for a particular asset class. You might be lower invested in that, but still you will have some pain because of that asset class going down. So you need to give your investments time. And I think for a multi-asset, it should be minimum 3 years. And for an equity fund of fund, it should be minimum 3 to 5 years, 5 year preferably. So if you are investing in for a 3-year period, then from a taxation perspective, your tax has 20% with indexation. And when you apply that indexation benefit, your net tax comes to close to between 8 to 12%. And generally below 10% mark because of that indexation benefit that you get. So, even your equities are taxed at beyond a certain amount of that 1 lakh rupee, that deduction that you get is still taxed at 10%. So here, after a 3-year period, you still come to a close to that 10% number in form of a tax. So it's not onerous; it's still at par. So fund of funds are not taxed adversely if your time horizon is 3-year, 5-year kind of time frame. Coming to the strategy, multi-asset, it invests in 3 asset classes: equity, debt, and gold. So we use quantum funds to kind of build that Lego blocks of the asset allocation. We use, for example, in equities, we use the Nifty ETF, we use the long-term equity fund, we use the ESG fund. For debt exposure, we use quantum dynamic bond fund and quantum liquid fund, large exposure to the liquid fund. And we use the quantum gold ETF to get the gold exposure. So how we kind of look at is relative valuations. We look at how valuations are there for equities and thereby what kind of position we should have in equity markets. And if it sounds risky, if the valuations don't make sense, we will be at the lower end of the range. So to give you an example, before COVID, we were at about 26% exposure to equities because even that time valuations were expensive. In the month of COVID, in March 2020, markets collapsed and by 40%, and it gave us an opportunity because valuations became reasonable, and we kind of increased our allocation from 26% to more than 50%. And as markets rallied further after as kind of COVID eased out and there was again a rebound in markets, we kind of gradually reduce our exposure to equities. So that is how we kind of play asset market cycles. If valuations make sense, we will participate. Even we have the flexibility to even increase our allocation from 25% to 50% if it makes sense. And at times when it doesn't make sense for a long time period, we may remain lower allocated to equities as well. What our objective or endeavor is to kind of generate returns that will give you higher returns than your fixed deposit. So fixed deposit really do not make sense. For a person in a 30% bracket, it is taxed at 30% irrespective of your time frame. Whereas a multi-asset fund after 3 years gives you a lower tax from 30% to say approximately 10% kind of tax in a multi-asset scheme. So it gives you that tax benefit, I mean advantage over fixed deposits as well. And it tries to generate you that better return than your fixed deposit. So if you look at long-term returns, it's very, very steady around that 9%, 9.5% mark over 10 years or 7 years or be it even at 5-year period. So it has given that steady return. And if you look at the volatility, if that is some measure of risk, eventually it is not, it is significantly less volatile. The volatility since inception is just about 6%, 6 to 7%. Whereas if you see equities will be somewhere in the range of about 15 to 20% in that range. So it is significantly less volatile. When markets are tumbled, it has not fallen as much. It has fallen significantly lesser than equities. When equities fell by about 40%, it fell by about, I think, 12, 13%. So it does not fall as much as equities do. It is not as volatile, and it gives you that steady state of return, which over a long period of time our endeavor is to give you in excess of your fixed deposits.
Thanks, Chirag. Arvind, can you help with this to our investor? He also asks that why not select a dynamic bond fund, maybe with a longer duration rather than a liquid fund, for a retail investor perspective, not from an institutional investor.
So the way to think about fixed income, fixed deposits, debt mutual funds is, why are you doing it? What is the objective of investing in fixed income? And then how much are you already exposed to fixed income, right? Because as I said, there are so many avenues. You have money in your bank savings, you will have some money in FDs. There's a EPFO allocation going from your salary. You would be investing in PPF if you don't have EPFO. You are already exposed to fixed income. And then so your objective should be, do I need more fixed income or do I need more equity? That's the first way to think about it. Then when you're looking at fixed income, the major objective I think of a fixed income is diversification. From what? From a risk of your other portfolio, which is equity, largely equity, right? So the objective of fixed income is to keep it liquid, safe, and diversify the volatility away from equity. As Chirag said, the equity volatility will be 15-20%, whereas in a debt product it will be below 5%. In liquid fund it will be next to nothing. Right? Then when you think about, okay, if my objective is only safety, then that approach of emergency corpus comes. And if you want to keep your emergency corpus, then it is better to keep it in a safe asset. If you still want to have debt exposure, if you're doing a dynamic bond fund, personally, a large part of my debt allocation is in the dynamic bond because I can live with the volatility that comes about. And I also I'm clear what kind of returns I'm going to earn over a period of time. That's very important. And I'm willing to stay long term. I'm willing to stay invested for 2, 3, 4 years and use that as my diversifier or a diversifying against equity. So the reason we don't automatically recommend that to retail investors, because timing a debt fund tends to be problem because people don't understand interest rate cycles, and they see a negative return like you will see in this month, and say, okay, why is the debt fund giving me negative return? And that's why we keep on talking about, when we talk about dynamic bond fund, we'll say have a 2 to 3 year horizon, and then after 3 years, as Chirag said, the capital gains, even like a debt fund is taxed with capital gains after 20% after indexation, then it gets better against fixed deposit. So if you're okay with near-term volatility, not as much as equity, but more than a fixed deposit or way more than your liquid fund, then choose dynamic bond fund, but stay invested for 2 to 3 years at least.
Thanks, Arvind.
And one more point: when you choose a debt fund, also, again, the objective should be that debt fund also should be. It might take market risk, but do not take too much credit risk in that, because again, the objective of fixed income is diversification, safety, and liquidity, and not trying to earn too much returns from fixed income. If you want to earn too much returns, you want to create wealth. Equities is a product. Debt is not the product.
So on the fixed income products, and so there was one more question. Like, if I have some idle money lying, should I look at FMP products also?
Same answer, right? What is your objective? If you're idle, you don't want to invest in equity, or you are already made your allocation, then you can look at multiple of fixed income. Right? Now, FMP, if it's like depending on the tenure and the maturity, you can look at it. As I said in the earlier slide, that in a rate increasing cycle, FMP is a fixed deposit. You're locking in your returns right now in a fixed deposit and an FMP. So depending on the maturity and what kind of assets, you're already determining your return. When interests are going up, it is better to be in what we call floating, which is your return should increase as the interest rates change. So maybe it is better to be in a liquid fund. Returns will be lower as compared, but over a 1 year, 2 year, 3 year period, it might be higher. So you can do a mix. You can do a mix of FD or liquid. You can do a mix of FMP and liquid.
Thanks, Arvind. This is to you, Nilesh. What do you think of quantum long-term equity fund given the current scenario? Are you looking at changing any strategy or looking at any new stocks, or what will your strategy for quantum long-term equity fund given, and even by considering the budget also? This is a question from one of our investors, is a long-term investor in quantum long-term equity.
So like I said, I mean, we believe there is an economic recovery underway. It could be a multi-year upcycle, and our portfolio is positioned for that. Again, we build the portfolio bottom up, and we continue to look for names that will come below our buy limit, given that we are value investors. And there are some stocks which are getting close to that. But again, by and large, we are happy with the portfolio we have right now. We believe it is geared enough to take advantage of an upcycle, and plus the quality of the companies that we have, especially the balance sheet quality of the companies, gives us enough comfort that they can handle interest rate volatility very well. So we are hopeful that next few years will be a lot better for the value strategy, and there could be changes related to stocks which come into a buy limit or stocks which move out. But by and large, I think the weights may not materially alter than they are right now. I think perhaps you might see a bit more tilt towards cyclicals, and perhaps weights towards technology and other defenses might get a bit lower because valuations in those pockets are getting higher. But apart from that, we just keep our basic job remains to go on the ground, talk to companies, figure out what is happening to the corporate capex cycle or corporate earnings, and price that into our company models, and then based on our valuation bands, hope for companies that we think are quality and at a reasonable valuation come to our portfolio.
Sure. Also, Nilesh, there's a question from the same investor. The expense ratio of quantum long-term equity is 1.29%. It seems on the direct part, it seems to be not on the higher side, but not also on the lower side. So what are Quantum's plan on the expense ratio the coming year?
Yeah, so I mean, before SEBI brought out regulations on expense ratio linked to AUM, Quantum had already put out a statement that as our AUMs grow, we will continue to reduce the expense ratio, which was one of the original objectives of having a low expense ratio strategy. So if you sort of benchmark us with already funds which are very, very large in size and compare our expense ratio to theirs, it might not look that we are that attractive on the expense ratio, especially on the direct plan side. But as our AUM grows, and if you then look at the roadmap that you've laid out on the expense ratio that we believe we will be at once our AUM scales up, I think again we will be one of the lowest priced expense ratio funds in our category and generally across equity mutual fund schemes. So I urge you to just go through that press release, look at the roadmap that we've laid out, and then compare us to other funds which are in that AUM bracket. And you will see that our expense ratio will be a lot lower than what they are charging right now.
Thanks, Nilesh. Chirag, you can take this. The question is on equity fund of fund. This is from one of our investors. Equity fund of fund has given a YOY of around 9.5%. So do you still recommend it? And if you recommend it, should be a lump sum investment amount, or how should we go about it?
Yeah, I don't think that's correct in terms of the performance of the equity fund of funds. Our performance is higher. It's closer to that 30% level. When BSE 30, we are outperforming and slightly lower than the BSE 200. So 9.5%, I don't know where the number coming from. Even a YOY as on yesterday is still closer to 23% return. So I think the numbers are not correct at 9.5. It's 29.5 probably, 29.75. So as our view says that, there could be probably an upcycle in the economy, and we are just beginning that journey. So I think if someone wants to make a lump sum investment and is not allocated much to equities, I think this could be a good time, given that there are not many surprises out there, and probability of that upcycle is higher. Plus, the equity fund of fund positioning today is also geared towards benefiting from that upcycle. So if you're not allocated, yes, this could be a good time to even add lump sum, because that asset class is looking attractive and probably may move higher from here. So we also saw some correction last month, and if there is a bout of correction, I think lump sum would indeed make sense to add. So yes, I would advise that if the allocation is lower, even this could be a right time to add to the equity allocation.
Thanks, Chirag, for taking it. You will get the right returns in the fact sheet. You can visit our quantumemc.com and you will get the fact sheet over there, or we will surely send it back to you. Yeah, Chirag, this is another question. This is on FM has not factored the global geopolitical risk and geopolitical environment risk while drawing annual Indian budgets. Does this mean that India is immune to change in the global markets in terms of growth projections? So what are your views on that?
So I don't think a budget should kind of factor in the geopolitical risks out there, because you don't know, because time and again we have seen there have been geopolitical clashes and it kind of subsides over a period of time. It's very difficult to say which geopolitical clash will kind of flare and become bigger. And I don't think that it needs to be factored from a budget perspective overall. What investors can do is kind of factor it in within their investments, and that is why we kind of suggest an allocation to gold, which kind of makes up if there is any flaring on geopolitical front. So India is not immune to any of those risks, and that is why your portfolio has to be positioned towards, so if there is that kind of risk that kind of pans out. So I don't think that budget should worry about those issues. The bigger issues out there globally is more inflation. I think budget did not kind of cater to that inflation risk that is lurking large for the economy. That should have been one of the areas where they could have focused and try. They have managed food inflation well over the last few years. But today the commodity price inflation has been higher, plus the energy prices have been moving significantly larger, which is leading to inflationary effects on the economy. The CPI is lower, but if we have seen time and again over long periods of time that the cost of spending overall is inching higher by about 10% per annum, effects of inflation plus higher consumption and better consumption. So on a pocket basis, it for India overall on an aggregate basis is increasing over long time periods since like 10, 20 years by about 10% per annum. So I think that is one major risk out there. There should have been some addressing that inflation risk but I don't think that geopolitical risk would be factored anytime in a budget kind of place.
Okay. Arvind, you can help us in this question. The investor wants to know what's better, passive investing or an active investing.
In equities,
Fine.
I'm assuming.
Yeah, fine. So what should we prefer, a passive funds or active funds?
We've been having a very clear view on this, that when you say passive investments, you're essentially tracking an index. Right? That index is created by a index provider with using different parameters of size and liquidity, and it usually does not take into account, say, governance as a factor. Right? What is the governance of that company? What is the integrity of the management? What is the corporate governance that they follow? It might not. It of course it also doesn't look at valuations for that matter. Right? It's just when it's an index created and you follow it. From a cost perspective, yes, passive funds and index funds are lower in cost, so it helps. But from these aspects of whether they have good managements, whether they have good businesses, will those managements be able to tide over crisis? Those kind of aspects are not there. Plus, India is a changing economy, right? In the structure of the economy is changing. So if you look at the indices that are created and you look at the number of companies that come in and go out of a BSE 30 or a Nifty 50 or a BSE 200, it's very significant. It could happen because of different price reasons, like price falls and they remove the underperforming index stock and put a high performing stock. It could be just that new companies from new sectors are becoming larger and coming into the index, and many other old economy or old companies are going out. So in that churn, you might invest in a passive fund, but the index is not passive. The index is very active. There has been constant up and down and changing, and there's a cost to it, right? The index fund also has to sell the ones which are going out and buy the ones which are coming in, and there is what we call impact cost. So if you look at from that perspective, given growing economy, changing aspects, and governance as a big factor in terms of how a active fund manager will look at companies with governance, with quality and valuations, we still think that being active in India is kind of better than passive. Cost wise, definitely passive, but all these aspects put together, there is definitely a case for active management.
Thanks, sir. Chirag, this you can take. This is the investor is around 50 years. For a 50-year person is investing in a balanced or a hybrid fund. 2 to 3 mutual funds for 2,000 to 3,000 each will be a good way to build a corpus. He may need the funds for marriage of 2 kids in 9 to 10 years in the coming year. So also should he consider investing options like PPF, FDs, NPS also mainly. So what's your suggestion?
Yeah, actually, given the time horizon that investor has about 10 to 15 years, I think that 12-80-20 can also work very well for the investor. I think, the 12 months of expenses that we kind of asked, that could, if one is not willing to take that high risk, then and needs more cushion, then that 12 months can be increased to 18 or 24 months, depending on one's comfort. But this orientation will work very well because the idea is for children's expenses, education expenses, which are increasing significantly year over year, and therefore a higher exposure to equities will help bridge that gap and ensure that the funds are in place. So maybe start with 12-80-20, and over a period of time, you can start building that kitty, which can help you set aside money for that education purposes. So I think I will still suggest that 12-80-20. Maybe if there is some risk averseness, then that 12 months can be increased to 18 or 24 months, but still stick to that orientation will help achieve that goal that one is looking for.
Thanks a lot, Chirag, Arvind, and Nilesh. We would like to, just before we part, we would like to have your 3 takeaways or 2-3 takeaways from the budgets that you had. Arvind. Yeah.
I saw a question earlier from that what is the budget for the common man? And it's a question that a lot of people ask. And the common man, with the R.K. Lakshman common man, which was a middle class, that is not true anymore. If you look at anybody who has an income of say a lakh a month, 12 lakhs in a year, they would be easily in the top 5 or top 10% of the economy. And so they are not common. We call ourselves middle class, maybe in terms of values and other, but if you see from an income perspective, India is a relatively poor, low income country, right? So a lot of us who call us a middle class actually in the top 5-10% of the population. For that segment, maybe there was nothing, and maybe there was no need, because if you look at in the pandemic, salaried class people who have managed to keep the jobs or business have actually saved money, and this is reflected data also. Savings of that class of investors or that class of people have actually gone up, because you haven't bought any new clothes, you've not needed to go for a vacation. There's there's been saving, right? So rightly, the government is not giving any major benefit to that segment. The other segment, which is what we said, that from that, they are the common, that other segment of low income, informal wage, farmers are getting some benefit. Some other wage people have not got that benefit. They're not getting that buffer from say high prices. Maybe as I said, maybe the budget should have done some more on that aspects. But this is still a growth focus. So, if that, as we've been saying for the last 2 hours, that the tailwinds that we are seeing and the global economy, and if some sane policies come through, we should be able to grow at a faster pace. And as the growth picks up, that will have its benefits. So these were the takeaways. Interest rates, as of now, it will increase. But I think we can live with that. As I gave you the 20-year horizon of interest rate, India has lived with a higher interest rate and still grown at 6.5-7%. So lesser of a long-term issue.
Thanks. Nilesh, your views on?
I mean, like Arvind said, it is a budget which looks at accelerating growth via capex. I mean, the big shift that happened last year in the budget was a government which was so focused on fiscal consolidation and refusing to spend suddenly decided, no, there is a problem and we need to spend. And they've essentially continued that plan. There is debate, or we could debate which is the best mode of spending. Perhaps some direct income stimulus perhaps would have been warranted, given the kind of pain that we are seeing at the lower strata. But at least it's a budget that continues to recognize that there is a problem in India and we continue to need to spend. That is a big positive takeaway. My only advice to investors is, by and large, over a period of time, budget has lost its significance. There's only so much that the government can do. And India still has a very large pool of very high quality company run by capable managements, which will continue to deliver very good performance over long periods of time. You look at the budget and you it's a good news flow. And I know a lot of news channels make a hue and cry about the budget. But by and large, if you just stick to your long-term allocation and let the fund managers do what they have to do and build a portfolio which can generate decent returns, and focus on your long-term asset allocation plans, I think you should be okay with that. I really don't think budget should be the basis of doing any major asset allocation. So that is why our long-term allocation does not change materially. It continues to remain a very simple solution for investors. And if you just go to our website and just look at the dashboard, you have a ready-made portfolio for you, which you can just follow and just look at and just ignore it for the next 15-20 years. And you'll be surprised what kind of corpus you end up accumulating over that period.
Thanks. Chirag, your views on?
Yeah, I think the budget had a strong thrust on sustainability. I think that's going to be a big agenda item for the government, for the corporate sector, and companies that are not gearing up will face a harsh reality somewhere down the line. So overall, I think sustainability, if you look at the ESG fund, has delivered well. The driver being sustainability as the driver for performance of these corporates. And that has, we have seen in a short time span of about 2.5 years, been delivering well to that expectation. So I think as it becomes the main lever, if you don't have an exposure to this agenda that is going to become bigger, not only in India, but globally as well, I think that becomes a good area where you can, as you would have heard the finance minister in her speech, that the sustainability word was repeated many times. And the main program on infrastructure is going to be powered by green technology. So overall, there is a bigger push towards sustainability. And I think that India ESG Equity Fund gives you that great exposure to bank on those sustainable companies to get you that long-term performance. So if you don't have an allocation to there, you have a track record which you can judge. You can see the portfolio in terms of companies which are quality companies and have delivered over the last 2.5 years. If you don't have an allocation, it will be good to start an allocation within your 80% equity exposure that you can diversify. And you need not do much work. It's readily available on the website in the dashboard that we have. You just see your equity exposure today, what it needs to be, and with a few clicks, you can rebalance it out on our website at the dashboard. So we will still, as Nilesh also said, that budget doesn't change that long-term orientation. It has reiterated that we are in an upcycle. There is a government push towards that upcycle. So this 12-80-20 will really work well for you as an investment thesis. So I urge you to look at our dashboard and try and see how you can shape your portfolio well, and it will do well over a long periods of time. More essentially, with the diversification that it has, it will give you good sleep at the end of the day, because no matter what the markets are doing, you will have enough good pieces in your portfolio, which will help you tide over good times and bad times. So with that, over to you, Sandeep.
Thanks, Chirag. Thanks, Chirag. Thanks, Arvind. Thanks, Nilesh. There were many questions around the budget. In fact, people do normally think that this may be a point to do a structural asset allocation or do some changes. In fact, but you can always visit our dashboard in the Invest Online section to have our suggested asset allocation strategy. If you have any questions more, you can please write to customercare@quantumamc.com. And we have also typed the email ID in the chat box. Any questions that you think you would like to get answered from us, please write to us. Once again, thanks for attending and giving your time. We will be soon sending you a recorded version of this webinar. It will be available for you. Any questions relating more, you please keep writing to us. Thanks, Arvind. Thanks, Chirag. Thanks, Nilesh, for giving your time again. Thanks a lot for.
Thank you so much.
Thanks all. Stay safe.
Mutual fund investments are subject to market risks. Read all scheme-related documents carefully.